Morning, everyone. Welcome to Cytonn full year 2017 banking sector report. As always, this is one of our key focus areas in terms of area that we focus on in terms of private equity and quoted private equity. We look at financial services sector, we look at education, we look at technology, and also we look at hospitality. Banking sector has been the core area in terms of even how we do our investments, and we are looking at a sector that has gone through a number of changes. We are coming from the era of Banking Act Amendment 2015 that actually stipulated the pricing in terms of loans and deposit pricing frameworks. And also now we are coming into an environment where again there are another in terms of different reporting standards that again will affect how banks operate. Going into 2019 again, though Kenya is around where we usually call the Basel 3, Basel 2.5 on their way to Basel 3, but again, best changes coming from Basel reporting will also affect the sector. All these are what you want to, the insight that you want to get in from this banking sector report, and also we are looking at coming in terms of operating environment, coming from where Kenya has gone through a difficult operating environment period, mainly to the year 2017. Things look up in terms of economic prospects for 2018, and also this one you'll get more details from the report. Going forward, I think if you look at most of our Cytonn weekly report, we've dropped insurance. We are going to focus more on the banking sector because if you look at even in terms of market performance, the top performers are mainly dominated by banks and mainly large cap local banks. So we are going to see a lot coming from us in terms of banking reports, mainly from East Africa and also from Sub-Saharan African report.
At Cytonn, our mission is to deliver innovative and differentiated solutions, financial solutions that speak to our client needs. Our vision is to be Africa's leading investment manager by consistently exceeding our clients' expectations. So we are led by 6 values. First is people. We look for people who are passionate and who can drive in a team context. We always deliver excellence. Our focus is always the client, and on entrepreneurship, we use innovation and creativity to deliver differentiated solutions to our clients. Accountability, always take personal and corporate responsibility for all our actions. And in integrity, we always believe in doing the right things at all times. We believe in strategy, and our strategy at Cytonn is that we pick a general direction and we execute like hell. So we have 82 billion of projects under mandate, worth of projects under mandate. We have 7 offices across 2 continents. We have over 400 staff, and we have 10 investment-ready projects. What makes us different at Cytonn is that we are independent and we have client focus, and we deliver alternative investments in real estate, private equity, education, and so on. Then we have strong alignment, which means that every staff at Cytonn has shares at the firm. So when the firm does well, the client does well, and the staff does well. The reason why we exist is that we collect funds from our clients, which include high net worth individuals, institutional clients, and global and local clients. Then we invest this firm in high growth opportunities, which are in real estate, private equity, fixed income, and equities. Then we deliver the best possible returns to our clients. So our business lines are in investments, alternative investment focused on private equity and real estate. We have real estate where we develop high-grade real estate developments. Then we have education. We are looking to provide education for our clients in other locations in early childhood development, primary education, secondary, and tertiary. Then we have hospitality. We're looking to provide service apartments and hotels. Then we have technology where we provide innovative technology solutions for our internal clients and also external ones. So in our solutions, we have high yield solutions where our expertise in alternative investments allows us to give our investors high returns. Then we have real estate investment. We have research capabilities where we're able to research, look for land and develop and manage our projects. Then we have private equity where we focus on education, hospitality, and technology services as well. So our products focus on 3 types of clients. We have institutional clients, high net worth individuals, and retail clients. And we have 3 major types of products: cash management solution, regular investment plan, and real estate development. So we have our team there, and our focus is the client and the client only. Then we are led by a 11-member board of directors, which is chaired by Professor Daniel Mugendi, who is a renowned scholar and the vice Chancellor of Embu University. We have Antihusi Aveninan, who represents our partners at Taleri. We have Mother Bala, who is partner at Stage B and Bala. We have Nasa Oloro, who is a director at WWF in USA and also the chair of our Innovation and Technology Committee. We have Mr. Maina, who is a well-established land planner and sits at the Executive Committee of Land Planning and Urban Development for the Kiambu County. Then we have Michael Bistro, who is the chair of CDSC and has over 30 years experience in roles in board and executive management. Then we have Rose Kimotho, who is the founder of Three Stones TV and also has experience in marketing and advertising. We have Madhav Bandari, who is the partner at Bekatili Maleri and has experience in corporate governance and structuring of procurement processes for various firms. Then we have our executive directors, Edwin H. Dande. We have Elizabeth Nkuku, who is also our CIO, and Patricia Wanjama, who is our head of legal and the company secretary. So our board of directors also makes up 4 committees, which are investment and strategy committees chaired by James Maina. Then we have the audit, risk and compliance committee, which is chaired by Madhav Bala. Then we have the governance and human resource committee chaired by Anti and the technology and innovation committee chaired by NASA. These are some of the projects we have: the Amara Ridge in Karen, the Situ Village in Karen, Alma in Ruaka, and Newtown in Machakos.
2018 is supposed to be a better year than 2017 was. So we look at different indicators, what we expected at the beginning of the year, what has been the experience in 2018, and then finally look at what we expect going forward. So we look at 7 metrics when we track what's going on in the economic environment. The first one is government borrowing. So at the beginning of the year, the government was behind borrowing. We expected government borrowing to be behind, but in 2018, we've since seen the budget being revised. So the domestic borrowing target was revised downwards and the foreign borrowing target was revised upwards. So this led to the government being ahead of borrowing, and with that, we are positive for borrowing going forward. In terms of exchange rate, at the beginning of the year, we expected a stable exchange rate environment. And then in 2018, we've since seen the currency actually hit a high of 100.8 to the dollar. We have also seen reserves increase significantly to $8.8 billion from $5.9 billion at the beginning of the year. And this is mainly due to receipt of proceeds from the Eurobond. So with this, we are still stable in terms of our outlook on currency, and hence we are neutral. For interest rates, at the beginning of the year, we expected upward pressure, but this would be countered by, since we had the act, we've seen the CBK actually reject bids that they deem expensive in the primary bond auctions. So we saw stability in the interest rate environment. During the 2018, the first quarter, we saw the MPC meet, the Monetary Policy Committee, meet and lower the CBR down to 9.5 from 10%. So going forward, we are still neutral in terms of our expectation on the interest rates. We don't expect any upward pressure on interest rates. In terms of inflation, we expected inflation to come in at an average of 7.5% in 2018. This is compared to last year, where it came in at an average of 8%. During the year, we've seen inflation come in at 4.8% in January, 4.5% in Feb, and 4.2% in March. So this is quite low, and it's within the government target of 2.5 to 7.5%. So with this, we are positive in terms of inflation, and we expect inflation to average 7% in 2018. We expected GDP to come in at 5.3 to 5.5% in 2018. This is annual growth for GDP. During the year, we've seen various organizations release their projections, and we took an average of about 13 organizations, then added our own projection. So with this, it came to an average of 5.5% growth in 2018. This is better than the estimate of 4.8% in 2017. So we are positive in terms of GDP growth in 2018. It will definitely be better than 2017. In terms of investor sentiment, we expected investor sentiment to improve and definitely become better in 2018. Last year, we had the whole issue with the prolonged election period, so investor sentiment was we were neutral in terms of investor sentiment. But at the beginning of the year, we were positive, and we are still positive. So far in 2018, we've seen the government borrow the Eurobond, and it was 7 times oversubscribed despite the challenges that were still ongoing. And then right now we expect that with the operating environment settling down, we expect investors to come in and take advantage of pockets of value that still exist in the Kenyan equities market and other sectors like real estate. So we are positive in terms of investor sentiment for 2018. For security, at the beginning of the year, we were still positive. We expected a better security environment in 2018, given we had concluded the election and the business environment was now settling down. So far we've seen that we've managed to even get direct flights from the USA. We've seen them lift their travel ban against Kenya. So we are positive in terms of security for 2018. So with the 7 indicators that we track, like I've mentioned at the beginning, 5 of them are positive and 2 of them are neutral. So this is definitely an indication that 2018 macroeconomic environment will be much better than it was last year. So we'll now get into an overview of the banking sector in Kenya. We'll look at the recent developments, or rather the developments that took place in the banking sector in 2017. And then from there, I'll hand over to my colleague Caleb, who will take us through 2018. So in terms of financial inclusion for the banking sector, we've seen this improve significantly to 77% in 2016. This is up from 59% in 2013. So this has mainly been driven by developments in terms of digitization through mobile financial services. So as per the chart that you can see, we've seen 2016 was actually 0 in terms of mobile financial services, but we've seen this grow over the years and it hit 71% in 2016. So this means that 71% of the population use mobile financial services. So we've also seen banking grow, the blue bars on the chart. We've seen banking grow, but not as fast as mobile financial services. In terms of the banking sector last year, we saw one acquisition took place whereby DTB acquired Habib Bank Limited and took over its branches. So that was the only acquisition that took place last year, but we've seen acquisitions take place over the years since 2013. So we've seen about 7 acquisitions take place, and they took place at an average price to book multiple of 1.8 times. So one thing we noticed is that this has been the price to book multiple of acquisition has been getting cheaper over the years. So it started at 3.2, 1.8, and 2.3 times. That's the acquisitions that took place from 2013 to 2015. But of late, we've seen acquisitions take place at as low as 0.8 times price to book and 1.7 times price to book. For growth in the banking sector, so last year we saw EPS growth decline. This is the weighted EPS growth decline to a negative 1% in full year 2017. So this was down from a positive 4.4% experienced in full year 2016, and it was mainly due to the cap, which led to net interest income declining, and also the net interest margin also declined to an average of 8.4%. That was down from 9.2% in full year 2016. So loan growth was at 5.6% last year. That's year-on-year loan growth, but it was lower than deposit growth, which was at 11.6% last year as well for full year 2017. So we look at the growth, the factors that we expect to drive growth in the banking sector. So we have diversification into different revenue streams. We've seen banks try to diversify to different revenue streams following the decline of net interest income after the cap was introduced in 2016. So the main avenue we've seen them venture into is bancassurance, with acquisitions by different banks and partnering with insurance companies to offer bancassurance. So we've seen this. We've also seen some banks venture into asset management and the likes. So in terms of technology, that's another thing that we expect to drive growth in the banking sector. So we've seen banks try to leverage on technology to improve their efficiency. So we've looked at things like mobile application platforms. This has enabled banks to actually use mobile application platforms to boost mobile financial services and use of that in terms of banking. So they can offer now banking through mobile, which has increased their efficiency. In terms of middle class growth, we expect the middle class to grow, and with this we expect an increase in the amount of, in the percentage of the population that will require banking services going forward. So with the growth of the middle class, this is also going to drive growth in the banking sector. The last thing we looked at is innovation. So we've seen banks venture into offering banking services through mobile and also agency banking. So this has enabled them to actually shut down some of their branches and encourage internet banking, mobile banking, and agency banking among the banked population. So recent developments that took place in 2017, we look at what exactly shaped development in the banking sector last year. So the first one is licensing of new commercial banks. There was a temporary lifting of the moratorium by the central bank. So this saw 2 banks come in and get licensed. We have Dubai Islamic Bank, which was licensed and will bring in an aspect of Sharia banking alongside First Community Bank and Gulf African Bank, which also offer Sharia banking. Then we have also Mayfair Bank, which was also licensed last year, and this brought the total number of banks in the sector to 40. Then we have a decline in private sector credit growth. We saw a decline in terms of credit growth to the private sector. It averaged at 2.4% in 2017. This is below the 5-year average of 14% growth. So this was mainly due to introduction of the cap, but it had already started before the introduction of the cap, when banks became more strict in terms of adhering to prudential guidelines, and this was after the bank started getting into receivership. So we have the fall of Chase Bank and we had the fall of Imperial Bank, which now led to less lending to the private sector. Then it was made worse by, of course, introduction of the interest rate cap in 2016. The third one we looked at is regulation. So we had regulations aimed at improving private sector credit growth. One of them was, first of all, the signing of the Movable Property Security Rights Bill. So this made sure that now people can actually borrow and use movable property as collateral. So it was supposed to increase credit growth to the private sector. Then we also had a training of MSMEs by a combination of the Kenya Institute of Management and the Kenya Bankers Association. This was mainly to help SMEs de-risk more and hence make them more lendable in terms of how banks can now be able to lend to SMEs. Then we have Chase Bank. So Chase Bank was sold. We saw an unbinding offer by SBM Holdings of Mauritius. So there's also an interest in terms of buy-in by foreign banks into local banks, and this is mainly due to the still quite high return on equity in the banking sector. There was also a launch of PesaLink by the Kenya Bankers Association. So this enabled customers or people who use banking services to make payments from one bank to the other in real time. So this has actually revolutionized how banking system works in Kenya. And then we have the launch of the cost of credit website by the KBA and the CBK in conjunction. So this ensured that banks and microfinance banks and also commercial banks have to post their true cost of credit on this. So this is basically posting the actual cost of credit and then any costs that are loaded up. So this increased competitiveness, because now with transparency in terms of the true cost of credit, it meant that banks now have to actually come down to where other banks are. So it increased competitiveness and was also meant to boost lending to the private sector. Then we have increased consolidation through mergers and acquisitions. So we've seen a lot of mergers and acquisitions, like I mentioned in the previous slide, with Habib Bank being acquired by DTB last year. In terms of development in the banking sector, the last two we have staff layoffs by banks. So we saw a lot of banks try to, with the decline in their main income stream, which is net interest income. So we saw banks try to become more efficient, and one way they tried to do this was by lowering costs. So we saw a lot of staff being laid off, around 1,620 employees in the banking sector as far as we could count, and also closure of branches just to decrease their operating costs. So we saw 39 branches also being closed last year. So asset quality was another thing. Asset quality was deteriorating last year. So we saw the total non-performing loans for the industry increasing by 22.8% last year to 197.5 billion Kenya shillings. That's up from 160.9 billion Kenya shillings in 2016 full year. So we also saw the gross NPL ratio deteriorate to 12.4%. This is up from 10.9% in full year 2016. So those are the recent developments that we saw, or the developments we saw in the banking sector in the whole of 2017. And the effects that this had is, it was mainly in terms of reduction of staff. So we saw a lot of staff getting retrenched from the banks that actually specified, the 12 banks that specified retrenchment. We saw the total coming to 1,620 staff being retrenched last year. And also in terms of branch closure, we saw 39 branches being closed last year. So those are the effects that the development in the banking sector had.
what has happened recently? We've had calls to repeal the interest rate cap. The Treasury has come out and said that it actually wants to have the law repealed following discussions with the IMF owing to the credit standby facility that Kenya still wants to access. In addition, there's been a lot of loans by international organizations giving loans to Kenyan banks. We have HF Group that got a loan of 1.5 billion from the Arab Bank for Economic Development, and also IFC gave a 15.2 billion loan to Cooperative Bank. This is because banks want to seek more long-term financing that is much cheaper in international markets. In addition, we found that Barclays is going to rebrand to Absa Group following Barclays Group PLC exiting from Absa, the Johannesburg listed Absa Group. This now will make Barclays Kenya to rebrand to Absa. In addition, the central bank has lowered its MPC, the central bank rate, to 9.5% from 10% previously. Initially, the MPC came out and said that owing to the interest rate cap, it has become a bit difficult to price in monetary policy. However, we saw in February the central bank rate coming down by 50 basis points. In addition, there's also a push to the non-funded income as more banks are looking to increase the non-funded income growth. One of these measures is going into bank assurance. We found that I&M Holdings has completed the buyout of UJ's insurance brokers, and also Sanlam has partnered with Standard Chartered, and this is just to grow their bank assurance business and increase their non-funded income. In terms of the metrics, loans and advances continue to grow. However, they're now growing at a slower rate compared to the historical average of 13.6. In 2017, loans grew by 5.6. This is slower than deposits that continue to grow at a faster rate. Deposits are almost growing at the same historical average, at 11.6% compared to a growth rate of 12.5%. In addition, we saw that bank branches also increased, but this is coming in at a slower rate than previously, and also the shareholders' equity is growing at a slower rate. In terms of the cost-to-income ratio, this has actually increased following the decline in income, following the interest rate cap, and we've also seen a deterioration in asset quality. We find that the non-performing loans has increased to 12.4%. From 10.9% in 2016. In terms of the margins, the net interest margin has also declined. This is because of the interest rate cap again, as it actually stipulates a rigid cap on the percentage that you can charge on your loans. Also, the loans to deposit ratio has come down. This is because more banks are actually taking more of their funds to government securities that they find are more they're risk-free. So on a risk-adjusted basis, they're giving more returns than actually loaning out to the economy. This has also resulted in the private sector credit growth coming in at 2.1%, way lower than 5.4% when the interest rate cap law was enacted. In terms of the growth metrics and earnings metrics, we find that the whole banking sector, the listed banking sector, realized a decline in core EPS growth by 1% compared to 4.4% growth in 2016. Here, mainly, this was resulted mainly because of the decline in net interest income that declined 3.8%. However, the non-funded income, it rose by 9.1% as more banks are actually getting more fee income business and channeling more of their resources into getting more non-funded income revenue stream, because it's not under the interest rate cap. In terms of the operating metrics, the return on equity came in at 17.6%. Loans actually came down from 84 to 80%, and the NPL ratio, asset quality, actually declined owing to the effects of the harsh economic environment in 2017. In terms of the trading multiples, we find that banks have actually increased, got more valuable in terms of their share price. We've seen a rally in banking stocks this year, and the current price to book value is at 1.8 times compared to 1.2 in 2016, and the P is at 9.9. Compared to 6.7. The rally in banking stocks came on the back of expectations of not as bad earnings, and also the repeal of the interest rate cap, hopefully being enacted this year. As you can see, the banking sector is at 1.8 times. However, the historical average is at 2 times, meaning that there is still some ways to go to the historical average. However, the banking sector is trading at a higher valuation than the insurance sector, which is at 1.5. But both are still currently below the historical averages of 2 times for the banking sector and 1.7 for the insurance sector. So just to summarize, in terms of earnings, we saw a decline this year because of a decline in net interest income owing to the cap. Deposits, however, mobilization and growth remain strong at 11.6%. However, more of the funds are being channeled to government securities than being dished out as loans, because the loan growth came at 5.6, which is lower than the historical average of 12.5. Asset quality still remains a challenge and a concern, because the deterioration in asset quality, we have found the non-performing loans has increased this year in 2017, and this we can attribute to a harsher operating environment in 2017. Going now to our banking sector report, how we carried out the report. Basically, we looked at all the listed banks following the release of their full year 2017 results, and we ranked them into the intrinsic value, franchise, and also the franchise value. In terms of the franchise value, this is looking at the bank the operating metrics of the bank in terms of efficiency, in terms of growth, in terms of asset quality, liquidity, and revenue diversification, and also capitalization. And then we looked at the intrinsic value to get the expected future growth potential and the expected return if you were to invest in that bank. In terms of banks that had a group structure, we used the group or the holding company to determine the metrics and the data to rank the bank, and following this we weighted them with the franchise value accounting for 40% and the intrinsic value accounting for 60%. This year, we're looking at the theme. We went with the theme of diversification and efficiency being key to growth amidst tighter regulation. In the last quarter, we asked ourselves what is next for the banking sector. What is it that will drive the banking sector amidst this tighter regulation? We find that IFRS 9 is coming in. We find that the interest rate cap is still in place. So after doing the analysis, we found that banks have to look at diversification and become more efficient to deal with this. In terms of the focus areas, we found that the regulation still remains with price control still in place, owing to the Banking Amendment Act 2015, which stipulates a loan and deposit pricing framework. So in terms of loans are capped at 4% above the central bank rate, which is now at 9.5. So the loans that a bank can give out are at maximum interest rate of 13.5. And also the transition to IFRS 9 from IAS 39. This will also look at credit loss in terms of expected credit losses. So you have to actually adopt a forward-looking approach when you look at your credit risk assessment. So these are the two main issues in terms of regulation that make it the banking sector actually have a tighter regulation this year, and we found that this has affected banks' profitability and will also have an effect on the risk assessment processes by banks, because the banks will now not be willing to lend out to more riskier customers, because they'll have to actually provide for more in terms of the IFRS 9. In terms of diversification, we found that banks have actually pushed to increase their non-funded income, which is not under the rate cap and under the domains of the rate cap, because this is actually now going to be the growth drivers for banks in this regulated environment. So we found that non-funded income has actually increased by 9.1%, compared to a historical average of 8.1. And this has also increased the proportion of non-funded income to funded income in the banking sector to 33% from 31% previously. In terms of efficiency, we saw a lot of restructuring coming in 2017, and we expect this to increase. Banks have actually they've had to adopt efficiency in getting the products to their customers, in mobilizing deposits, and also in disbursements of loans, because this is owing to the expected decline in income. For banks to remain profitable, they have to increase on their efficiency. So we found a lot of banks increasing the operational efficiency. We saw a lot of restructuring in the banking sector, a lot of branches that were being closed, a lot of staff layoffs, and we expect this to gather pace still in this year. However, owing to an expected better economic environment, possibly the restructuring and the layoffs will not be as much as last year. In terms of asset quality, this remains a concern in the banking industry, as there's been a deterioration in asset quality this in the past year that we attribute to the harsher economic environment. However, it still remains a concern because banks will now have to provide more for expected bad loans and loan loss in this year, owing to the adoption of IFRS 9. And in conclusion, diversification and efficiency are going to be the key drivers for growth in the banking sector this year, owing to the tighter regulation brought about by the interest rate cap and the IFRS 9 adoption. And we see this, in order for banks to remain profitable, we see these as the main drivers and the main focus areas coming into 2018. In terms of the rankings by franchise value, we did a franchise value ranking, and we found that KCB Group emerged top. We looked at the loan to deposit ratio, where we got a loan to deposit ratio average of 85%. That is considered an optimal loan to deposit ratio, and KCB actually was close to that. KCB also ranked high in terms of return on equity, where it was second only to Equity Group at 19.5%. In terms of the other metrics that we looked at, we also looked at cost to income ratio, where the bank that had was the most efficient, had the least cost to income ratio, emerged top in this ranking. Here we found that I&M Holdings was the most efficient, with a cost to income ratio of close to 50%. In terms of return on average equity, the bank that had the most profitability return to shareholders in terms of the return was ranked top, where Equity Group actually emerged at the top. In terms of net interest margin, what margin you're getting in terms of what you're paying from your cost of funds and what you get from the interest earning assets, the yield on the interest earning assets that you give out in terms of loans and in terms of investment in government securities. Here, Barclays had the highest net interest margin. It came in at around 9.7%. In terms of the PEG ratios, here we look at the earnings of the bank that gives us the price to earnings ratio, and also factor in an expected growth rate over the next 5 years, with the bank that is the most undervalued in terms of the growth rate and its PE ranking the top, where KCB Group actually ranked the top. In terms of the price to tangible book value, here we just look at the book value of the bank and what price the bank is trading at, share price, so that we compare the share price to the book value per share. And the most undervalued bank was HF Group, that's trading at a price to book value of close to 0.5 times. So it's trading at 0.5 times to book. So there's a lot of value if it were to trade, even if it were to go back to its book value. In terms of deposits per branch, we look at this as an efficiency metric, where the bank that can gather as much deposits compared to the branches that it has, being the most efficient in terms of its branch allocations, if you look at the deposits that it gets. And here Stanbic Holdings was the most had the most deposits per branch at 5.5 billion. So we found that in terms of its branch allocation, the deposits it gets, it's the most efficient. In terms of the gross non-performing loans ratio, here the less non-performing loans you have, the better you are in terms of asset quality. And Equity Group had the least non-performing loans at 6.2%. In terms of coverage, how much do you cover? How much do you provide to cover for your non-performing loans? Here we found that Standard Chartered Bank had the highest coverage ratio at 74.4%. So it provided the most for its non-performing loans. The bank provided the most, set aside the most provisions for its non-performing loans. In terms of the tangible common ratio, here we look at how the bank is in terms of its equity compared to its assets, with the I&M Holdings having the highest ratio of equity to assets. Just in case of liquidation, it should be the most solvent. In terms of non-interest income to the revenue, this is a diversification metric where the bank that has the most non-funded sources of income is most diversified in terms of having the least funded proportion of income to its total income. Here, Stanbic Holdings had the highest non-interest income at 44% of its total income. We also looked at a Camel rating, where we look at the capital adequacy of a bank, asset quality, management, earnings, and liquidity, where Equity Group emerged the top. And in terms of corporate governance, we also have a corporate governance index and a corporate governance report. Currently, KCB Group in the banking sector is ranking the top in terms of where we look at a board's how the company is run in terms of its board composition and earnings and management, and a lot of other corporate governance issues. So in the franchise ranking, KCB Group remained top, and Equity Group came in at number 2 from Q3 rank of number 3. In terms of intrinsic value, here we look at the total potential return that you might get if you were to invest in a stock as a shareholder. What is your total potential return? We found that NIC Group had the highest potential return of 42% from an intrinsic value. So we found that the fair value is at around 61 shillings per share. Followed by Diamond Trust Bank at 31% and KCB Group at 27%. NIC Group maintains the highest rank, given it still had the highest potential return in Q3, and Diamond Trust Bank is now the second highest return from Q3. In terms of getting the intrinsic valuation, we look at a number of valuation techniques. We look at the discounted cash flow, we look at the relative valuation method, and we weight them 75% for a DCF method and 25% for the relative valuation. Now, putting them both together, when we take the intrinsic value and the franchise value, we weight them 40% for the franchise and 60% for the intrinsic value. We found that KCB Group remained top with a weighted score of 23, and followed by Equity Group that rose 2 places to position 2 from position 4 in Q3. Equity Group has had a good performance in 2017 with a 14% increase in earnings. KCB Group maintained its position owing to its good franchise value and its also good potential return. In terms of the rankings, Cooperative Bank declined 2 positions, and Barclays Bank also declined 3 positions from what we had in Q3. And National Bank and HF Group, they maintained their position 10 and position 11. And that is it from the investment team.